Let's say you want to buy a rupees 100 Nifty option, and since the lot size is 25, you figure one lot costs rupees 2500. With rupees 50,000 in your account, you think, I can go and buy 20 lots and jump right into the trade. But can you really afford the risk? You're putting your entire capital on the line. Even with a 20-point stop loss, you'd lose rupees 10,000 if it gets hit. Just 5 losing trades and your capital is gone. Plus, the stress of such big risks can lead to sleepless nights and bad decisions. This is why it's so important to manage your risk wisely. How much money do you need for options trading? Social media is packed with stories of people making big money by going all in on options trading in India. These folks got lucky, but most people who bet big end up losing their savings in years of hard work. A lot of new traders fall into the same trap when they start out. In today's video, I want to talk about two very important aspects. First, what account size should you have for options trading? And second, how much quantity should you be buying in each trade? Let's tackle the first one first. When trading options, it's important to be careful with how much money you use. A simple rule is to use only 10% of your total investments for options trading. For example, if you have rupees 20 lakhs to invest, you should not use more than rupees 2 lakhs for options trading. This amount is the most you should be prepared to lose. It's important to set this limit for yourself as a hard rule. By following this guideline, you avoid risking too much of your money and you make sure you have enough left to invest in other areas that can grow over time. Every trade or investment is like a bet. You put money on an option or stock hoping it will go up so you can sell it for more later. But you can never be certain about this, especially with options. Putting all your money into one trade is risky and stressful because you might lose everything. Conversely, investing a very tiny amount like 0.001% of your account might not make a difference. So that's where position sizing comes in. It's about choosing how much to invest in each trade to balance risk and reward. In trading, there are different ways to manage this, like fixed size, constant portfolio fraction, martingale, and Kelly criterion. Today, I want to focus on fixed position sizing. This method is simple and it shows you exactly how much to risk each time, helping you stay calm and make better decisions. Let's say you have rupees 50,000 in your trading account. You need to decide how much of this money you're willing to risk on one trade. A common guideline is to risk 2% of your account per trade. So for 50,000, that's 2% of 50,000, which is 1,000 rupees. So if you lose the trade, you would lose only 1,000 rupees. It's that simple. For smaller accounts, you might risk up to 5%, and for larger accounts, you might go lower, like 1%. It all depends on how much risk you're comfortable with. Next up, let's talk about setting your stop loss. Think of a stop loss as your safety net. For this example, let's assume your trade needs a stop loss of 20 points. This is the point you think your trade will not work and you want to exit. So let's break it down. Imagine you want to buy options and each option costs 100 rupees. And each option contract involves 25 shares. So the cost per contract is price of the option times contract size, which is 100 times 25, 2500 rupees. So one contract costs 2500 rupees. Now if you set a stop loss of 20 points, the risk for each contract is stop loss points times contract size, which is 20 times 25, which is 500 rupees. To keep your risk under 1,000 rupees, you need to find out how many contracts you can afford to buy. Divide your risk limit by the risk per contract. So maximum contracts is risk limit divided by risk per contract. That's 1,000 divided by 500, which gives you 2 contracts. So you can buy 2 contracts while staying within your risk limit. Simple, right? In short, with 50,000 in your account and planning to risk 2% with a 20-point stop loss, you can safely buy 2 option contracts that cost 100 rupees each. On Punch, you can just turn on Shield and set the amount of capital you're keeping for options trading, and you'll have all your risk settings readily available when you take a trade. It's designed for part-time traders, offering a user-friendly interface and safety features to boost your confidence. The secret to successful trading is to focus on managing your risk first before aiming for profits. By controlling your position size and using a stop loss, you reduce the chance of big losses and trade more confidently. Stay disciplined, and options tradings can be both rewarding and manageable. Thanks for watching, and share with your trader friends. Happy trading!